Former President Trump telling Bloomberg in an interview that if elected in November, he will curb inflation by opening the United States to more oil and gas drilling. Joining us right now to talk about this and the state of the American and global energy markets right now is Daan Struyven. He is the head of oil research at Goldman Sachs. And let's just talk very quickly, Don, about where things stand right now. We've seen very low volatility. It feels like oil is not something we talk about all that much because it's come into a range that's fairly comfortable for both sides of the equation.
It's great to be on. Yeah, absolutely. So Brent crude oil prices are bang in the middle, over $75 to $90 per barrel range. We had a modest decline in oil price over the last couple of weeks as the risk premium from the Middle East and hurricanes retraced, as we saw some softer demand data out of China. But then on the bullish side of the spectrum, the expectation that the Fed is going to cut soon and evidence of crude draws in the U.S. are sort of limiting decline. So very much in the middle of a range. And implied crude oil price volatility is now at a 9-year low. And while we had always predicted that our range-bound framework for prices would imply lower volatility, at this point we're starting to discuss with investors, is volatility too low, especially ahead of the U.S. elections?
Okay, so you think there could be more at play. We did have an analyst earlier this week who said that, look, there are a lot of areas of the equities markets that might perform better under a Trump administration, but oil is not one of them. His point was that more drilling that might come with a Trump administration might be good for consumers, but it's never good for suppliers because more oil means lower prices.
Regulation in the oil sector is definitely an area of focus. Our DC economists would expect that under a potential second Trump administration, you would see some regulatory easing. For instance, an expansion of leases on federal land or offshore production, or a rollback in the methane tax. However, the key point to make is that these regulatory easing measures could provide upside to long-run oil production, but have likely limited effect on the outlook for production in 2025. And oil, and that's very different from equities or bonds, is a spot asset. You really price spot fundamentals over the next few quarters, as opposed to looking several years ahead.
What is the volatility concern? What do you think needs to happen here? Why do you think it should be more treated with a little more caution?
Yeah, so to be clear, we had anticipated that volatility would come down last year and this year because OPEC is balancing the market. Oil demand growth and GDP growth are broadly in line with their long-run trends. But I think there's a lot of open questions with respect to the elections and the oil supply and demand balance. For instance, on the supply side, are you going to see a potential reduction in supply from Iran if secondary sanctions were enforced more strictly? Or do you see a boost to U.S. production over the long run if you see regulatory easing? Then on the demand side, also a lot of open questions. Could a trade war weigh on global oil demand and global GDP? Or would tax cuts and business-friendly policies boost GDP and boost demand? So quite a lot of uncertainty here that could actually push volatility up from its current 9-year low.
Okay. The risks to that?
To a range of 75 to 90? Yeah. Modestly to the downside, because we're quite confident that 90 is a ceiling in most geopolitical and economic scenarios for two reasons. One, OPEC has clarified that if the market tightens, they're going to raise production starting in October. There's a strong willingness to do that if the market conditions allow to do that. And second, the high-frequency data are a touch softer in the oil market, especially on the China demand side. And then in the U.S., on the production side, U.S. production continues to surprise to the upside.